Welcome to Binary Options Moving Averages Strategy. This topic is brought to you by binaryoptions.net.au. Used as a technical indicator which assists traders in smoothing out price action by filtering out the noise from breakout price action, moving averages shows the average value of a stock's price over a period of time, giving weight to each daily price. Considered one of the most popular trading tools and used as a lagging trend following indicator, which can assist in identifying support and resistance levels as well as producing buy, call, and sell, put trading signals. Moving averages does not predict price direction, but rather is used to define the current trend. Considered by traders as one of the most simple and easy to interpret indicators, when a moving average line is rising, the trend is considered bullish. If a moving average line is falling, the trend is considered bearish, while a sideways moving average line indicates a flat, trendless market. There are a number of moving average calculations which traders can use, all of which give a different weight value to each price period. These include a simple, exponential, variable, triangular, weighted and smoothing moving average. The two most basic and commonly used moving average indicators are the simple moving average and the exponential moving average. A simple moving average shows the average value of a stock's price over a period of time, giving equal weight to each daily price, while an exponential moving average places greater weight on more recent data, reducing exponentially as it is calculated back in the series and is therefore considered more reactive to recent price changes than the simple moving average. A weighted moving average assigns a weighting factor to each price value in the time period according to its age. The most recent data gets the greatest weight and each price value gets a smaller weight as we count backward in the series. Other moving averages such as a volume and smoothing add a volume-weighted allocation to each time period in proportion to its trading volume and smooth the data through a filter before calculating respective output values. Short and long-term traders use moving averages to identify changes to the trend using short, intermediate, and long-term timeframes in their calculations. The most commonly used moving average timeframes are the 10-day, the 50-day, and the 200-day, and are used by short, medium, and long-term traders respectively. With regards to moving averages, traders consider the time frames used to be either fast or slow. A fast moving average is a short-term moving average such as 5, 10, or 25-day period and is considered more reactive to daily price changes. A longer-term moving average, such as a 50 or 200-day period, is deemed slower as it references price action over a longer period with considerably more lag. However, price noise is noticeably more smoothed as opposed to short-term moving averages. Since we have discussed the basics of moving averages, we can now consider how to use a moving average for trading profit, the moving average crossover. A moving average crossover strategy can be used as a valuable tool for binary option traders. Not only is the strategy reliable, it is simple to execute with clear call and put trading signals. A moving average strategy is considered to be high probability yet relatively low risk. For short-term binary options traders, we can accurately rely on two individually charted moving average indicators to identify shifts in momentum and generate trading signals. Using a slow moving average, such as the 20 or 22-day exponential moving average, and a fast average, such as a 5 or 6-day exponential moving average, traders can simply chart the moving average on top of the price movement of the stock. The crossover points between the slow and fast-moving averages generate the buy and sell signals. For binary traders, a call signal is generated when the short-term moving average crosses above the longer-term moving average, while a put signal is triggered by a short-term moving average crossing below a longer-term moving average. Shorter-term moving average crossovers also serve as a support and resistance indicator, used to identify short-term price targets and key levels. For long-term binary options traders, by using longer-term moving average crossovers, major shifts in the market sentiment can be identified. Traders use what is known as a golden cross, which occurs when the 50-day moving average rises above the 200-day moving average as a bullish buy signal. Conversely, long-term traders use a death cross as a bearish sell sign, which occurs when the 50-day moving average drops below the 200-day moving average. As opposed to short-term moving averages, traders identify that price is often trapped between medium and long-term averages, whipsawing between price extremes, presenting ideal trading opportunities for binary option swing traders in this zone. Furthermore, once penetrated, the 200-day moving average begins to act as a major resistance level after the medium-term moving average drops below it, and major support following an upward breakout. While a moving average crossover is considered to be an effective trading tool which generates reliable trading signals, advanced traders often pair moving averages with other technical indicators such as moving average convergence divergence, Bollinger Bands, and the McClellan oscillator. Advanced moving average charting techniques assist in signaling divergences with price, overbought and oversold levels, and changes in trend momentum. For more information about this topic and more binary options trading strategies, please visit binaryoptions.net.au.